All right, I think we're going to get started now. Welcome, everyone. We appreciate you joining us today. I'm Bill Morrow. I'm one of the managing partners at ECS. We hope you're all well and safe and stay that way. Over the past few weeks, we've been getting many questions from clients about how they take care of their company's current financial needs while putting themselves in the best position when coming out of this pandemic. As we are getting many of the same questions and concerns, we decided to put those answers together and share those with you today. While all companies have unique circumstances, we feel the material we will be touching on is key for successfully navigating through this crisis. Our agenda will consist of a 30-minute presentation where we'll be sharing with you how we look at your company's financial status from 3 different levels: near term, mid-term, and long-term. We'll then cover off any questions you may have in a 15-minute Q&A session. Feel free to click on the Q&A button at the bottom of your screen and submit questions at any time. While you will not be able to see the questions, we will be receiving them and answering them for you. You should have also seen the polling question pop up. If you have not seen that polling question pop up yet, feel free to click on the polling button at the bottom and answer the questions. We'll share with you the results at the end of the webinar. And just a programming note, we will be recording this webinar and sending out an email with a link to the video upon completion. For those of you not familiar with ECS, we are a comprehensive business transformation company focused in on helping clients achieve and exceed their goals. Our team of business leaders have the experience and know-how to build great strategy while helping you execute to success. We do this across all functional areas in the company, from finance, operations, sales, marketing, HR, and recruiting. We provide services in 3 ways. 1, our Fresh Eyes assessment, which provides companies a comprehensive outside view of their business. 2, working alongside your team in fractional support roles to give you the additional horsepower you need to get to the next level. And 3, filling crucial C-level roles like CFO, COO, CRO, and giving you a C-level executives you may be missing, either temporarily or fractionally. Leading our discussion today is Rob Williamson. Rob is a partner at ECS and a key leader in our finance division. He helps support companies by providing operational financial expertise. Rob has an extensive, comprehensive background working in both for-profit and not-for-profit companies. His experience includes the integration of operations and finance, developing financial strategy, and working capital management. Joining Rob on the webinar today is Jason Fisher, managing partner at ECS, where he also co-leads both the operations and HR teams. Jason has supported our clients by providing expertise in operational excellence, integrating finances and operation, handling change management, and developing high-functioning business processes. He works with ECS clients in over 20 different industries, providing executive leadership and helping navigate change. And with that, I'm going to hand it over to Jason.
Good morning, everybody. So today we're going to discuss how to navigate through COVID-19 from a financial operations perspective. While doing so, we don't want to lose track of the impact all the people during this pandemic, and our thoughts are certainly with those sickened by and those combating the virus on the front lines in healthcare, food supply, logistics, and more. So the question for us as business owners is, how do we handle the finance implications to our business? We want to start by saying it's key to keep in your mind that we can only control the controllable. So the challenge for us becomes to think in phases: the now, the midterm, and the long term. You'll leave this webinar knowing the following: what should I be doing right now? And we're defining that period mid-March through end of May. This is fluid and will be a little bit different for everybody. What should I be doing over the medium term? We're really looking at the June through August timeframe for that. What should I be doing throughout the balance of 2020? So think July through December. And what should I do to be best positioned for the future, 2021 and beyond? So we're not alone. Everybody's facing this together. Social distancing and mandated closures, it's the largest demand shock since World War II, and it's greater than the 9/11 events. All sectors are being adversely impacted by the pandemic. but there's significant variability within the sectors. And some sectors and some individuals within sectors have found opportunities to pivot or succeed, and we'll talk about that a little bit later. Economists have different rebound models, but too early to tell with real confidence how this plays out. Smaller organizations expected to be more severely impacted than larger ones, and restart costs will be crucial. So for some organizations, they'll be too large. And when we speak about restart costs, think for a moment about what the cost to restart your operations will be: supplies, payroll, fuel, marketing, etc. However, your revenue in most cases will be lagging. So with that, I'm going to turn it over to Rob.
Thanks, Jason. So when we look at what we should be doing right now, the single most important goal for the right now is developing a cash flow projection. But a cash flow projection, at least down to the monthly level, if not the weekly level, and one in which you have reasonable confidence. Cash flow forecasts do vary widely between organizations in their accuracy and their rigor. And I think every organization has opportunity to improve their cash flow forecasts. The COVID-19 circumstances, as we see from the newspapers, are changing almost daily. And so you want to do a cash flow forecast, I'm recommending under 3 different scenarios: an optimistic one, a pessimistic one, and a most likely. You'll still have to revisit your projections, but by developing projections under 3 different scenarios, you won't have to revisit those projections as frequently. I recently did a cash flow projection for a client in the retail sector, and I used 3 different operational modes: closed, open as normal, and what I'm calling go slow. I did 3 modes because it's not a binary thing, totally closed or operating as we were in January. That 3rd mode that I'm calling go slow represents anything from a phased return to normality, whether through an easing of the government mandated restrictions or just a gradual return of business and consumer confidence. So when you project out your cash receipts from customers, you want to do that through the lens of how COVID-19 is impacting their operations. And if your customer base, for example, if it's heavily skewed to, say, the bricks and mortar retail sector or the restaurant sector, then the impact of those customers is going to be far greater than if, for example, your customers were online retailers. Turning to the process side of things, the theme here is to be much more hands-on with cash flow matters in particular than you used to be more closely involved on a personal basis in those situations that in the past might have been fully delegated to others. For accounts receivable, you should be very diligent in collecting those debts that were already overdue before COVID-19 started, as well as super careful about extending further credit to customers like that. You also want to be closely and personally involved in routine, ongoing collection and credit management issues. And again, look at it through the lens of which customers are likely to have been most severely impacted. On the procurement side of things, again, the theme is still being more closely and personally involved and exercising a greater level of scrutiny over outgoing payments, cash leaving the building, and delaying non-essential items. Particularly think about which capital projects should be paused or possibly even canceled. Just because CapEx doesn't immediately hit your P&L, it's EBITDA neutral right at the time it's incurred, it's still a cash outflow, and these capital projects, they're very often larger in magnitude than routine OpEx outflows.
Okay, let's talk about production and service pivot for a second. So the real question here is, can you pivot to a new product, service, or combination thereof to generate revenue, work, and staffing during the pandemic? I'll give you a few examples. You may have read about some of these. Distillers moving from alcohol to sanitizer production. We have an accounting firm that we work with that figured out a safe way to support tax filings for assisted living communities while others have moved away from those facilities. And distributors moving to support distributions for others by utilizing their resources for warehousing, fleet, etc. So as individual business owners or leaders, evaluate if there's any opportunity for you to pivot your products or services. Secondary, you want to look at condensing operations where possible, hours, services, staffing, all to help your cash flow. As we talk about human capital, if you have not yet, you need to determine critical roles versus non-critical roles. And I want to emphasize, it does not mean all of your positions are not important in normal times. However, how and in what order do you ramp down staff? What can you maintain? And then how do you ramp back up? Key example here is we've seen many companies reduce their sales forces quickly. However, what happens when you return to some level of operations? This may put you further behind the 8-ball, right? Consider furlough versus layoff. Reality is to lessen payroll, but furlough allows you to return a person to work quickly, while layoffs will require more paperwork and time. Communication. Keep your team members, both active and furloughed or laid off, in the know. Be candid and do not be afraid to be realistic. When we talk about supply chain, know your supply chain not for what it was, but for what it will be. As part of a customer's supply chain, expect customer approaches on contract provisions, price and credit terms, and ensure you have developed an appropriate response, as well as customer contacts are aware of your organization's stance. This can and should vary customer by customer. Your supply chain, what impact have your suppliers faced? Are they up and running, or are they struggling to get back to some sense of normal? We expect to varying degrees supplies to be disrupted, lead times extended, and supply chains to be fluid. Keep in mind that you'll not be the only business that needs to ramp up. Some variables that will play in but yet are unknown. Impacts may trigger a broad reassessment of sourcing decisions, including locations. There's potential for new regulatory and governmental considerations that may pre-exempt what you're used to. So from a supply chain perspective, you need to evaluate how your suppliers are likely to be affected, foster closer communication with different tiers in supply chain, including customers. Data sharing, including forecasts, can reduce chance of experiencing the bullwhip effect. So think about the toilet paper phenomenon in the country. And reevaluate practices regarding if your manufacturer batch ordering sizes, safety stocks, and just-in-time ordering.
So if we turn to the what we're calling the midterm now, we're talking June through about August. There are some additional things to address. You should be looking at improving the transparency of cash flow in your organization and making sure that key leaders are aware of cash flow triggers and also the risk points to cash flow, so they understand what's controllable by them and what may not be controllable. Also consider distributing the cash flow report more widely. Often only the P&L is distributed to leaders and operators each month. Add the cash flow report to that distribution, and you'll get people's attention pretty quickly if they see red ink on that cash flow report. Also, you should ensure that you don't have an organizational culture that sees CapEx as free money. Some companies that I've seen have developed quite a cavalier attitude, let's call it, to capitalizable expenses. I've seen situations where a company would literally spend more time and effort on getting suppliers to reword their invoices to make them capitalizable than they did at the outset on negotiating price from those suppliers. This is also a good time to take a fresh eyes look at the credit terms that you extend to your customers, as well as the credit terms that your suppliers have granted you. There's credit terms that might have made sense pre-COVID-19 back in January that may not make sense now, particularly in light of how much your customers are impacted. You may be able to change some credit terms to your liking, others you may not be able to change. It all comes back to what Jason mentioned about focusing on what's controllable and controlling that. Also consider if a deferral of rent request is appropriate or possible. Now, many jurisdictions, you've probably read this in the papers, many jurisdictions have banned evictions during the COVID-19 crisis. But that doesn't mean that other contractual non-payment provisions will be suspended. Also, your longer-term relationship with the building owner is important, and you're not going to want to move into a default situation without a clear written understanding between you and the building owner. Some landlords that I've seen are helping out their tenants with rent, but that help, I suppose unsurprisingly, tends to be more along the lines of suspending rent payments while operations are closed, but then catching up with a retrospective payment once things open up as normal. Now, everybody has enough, more than enough, to focus on right now without having unnecessary problems such as, say, a tax non-compliance situation. And some tax deadlines, some important tax deadlines have been shifting. For example, the federal government, the income tax requirement, the 415 tomorrow, that is, that filing and payment deadline has been shifting, but other things such as payroll tax filing deadlines have not been changed. Also, the landscape is different with state and municipal tax filings. Again, some have changed and some haven't. So the key thing here really is to make sure that you stay in close touch with your tax professional, because that's the person who's going to be best positioned to stay on top of these continually shifting compliance requirements.
All right, the next thing that's going to be critical is to start to plan out how you will return to operations. While it may not feel like it, now's the time to start to plan how you ramp back up, contingency planning, and the what ifs. So when we talk about returning to operations, don't expect to return to pre-pandemic conditions overnight. Situations will be fluid, and there is the potential for setbacks, i.e. rolling waves of what we experienced in lieu of vaccines being readily available. Develop your ramp-up plan. Think human capital, supply chain is critical, customer communication, and then some things maybe not everybody's thought of, but what training is needed, hygiene, disinfecting workspaces, what's changed post-pandemic or during the pandemic, what procedures need to be added, changed, or removed. And then as you're doing this, continue, if you have a business continuity plan, adjust it. If you don't have one, put it in place and start to develop it. Be ready to have to ramp up or down. Be prepared for closures, be prepared for continued supply chain disruptions, and for the need for remote capabilities. As a consulting company, we're very big advocates of having business continuity plans in place. No one would have quite predicted this level of impact 6 months ago. But if you can think for a moment about your own situations, and did you have continuity plans in place that at least in part allowed you to focus on critical issues versus completely starting from scratch? And how much time was spent on who, what, and how versus actually doing?
So if we look beyond the near term and the midterm, what are the main things that we should be looking at through the balance of 2020? So 2020, there's just under 3/4 of the year left to go. And one key question is how to keep teams motivated. Some companies' targets for 2020 may already essentially be shot, and some of their people might throw in the towel. That's obviously not something that anybody wants. Particularly with the remote work environment, some of the usual tools that we have to motivate people just may not be available. For example, if you were to, usually gather around and say publicly celebrate people's achievements each month as a means of motivating them, well, it's pretty hard to do that right now. So there's a need for some lateral thinking and how to motivate and recognize people. You're going to need a full 2020 forecast. And again, under those different scenarios that we talked about, optimistic, pessimistic, and most likely. There may be some scope to renegotiate your 2020 targets, but if you do that, if you go down that route, you'll need to do so with a specific ask in mind, and a specific ask that's supported by some rigorous and logical projections. You'd also want to stress the actions that you've been taking to ameliorate things. Key here is to communicate early and often with the ownership and executive leadership in your company. In terms of banking, we can expect that credit will be tighter for some time. Also expect significantly increased due diligence from the banks on any new financings, as well as more stringent covenant requirements. Also, even if your bank has had a fairly light touch with you in the past, you can expect them to be reaching out much more going forward. Also, reevaluate your covenant compliance situation as well as your interest cover. Figure out how much cushion you've got regarding your covenants for the balance of the year. Again, given the work that you've done on your optimistic, pessimistic, and most likely P&L and cash flow forecasts. Bankers hate surprises. I mean, I think we all do. So if your projections do predict a crunch regarding your covenants or the adequacy, say, of your credit line, you'll want to get ahead of the game and start some dialogue early with your bank. In terms of contracts, you should be looking at your major contractual rights and obligations. Look for some key provisions in those contracts that might be affected by recent events. For example, reps and warranties, termination rights, covenants, change in law clauses. Also identify if there are any notice requirements that have been triggered or might be triggered in the year to go. Consider whether there's any alternative means by which you can perform your contractual obligations, or potentially some proactive steps that you can take, anticipating potential future effects of the outbreak in the year to go. Also, make sure you have a process of staying on top of any evolving local regulatory actions and restrictions, including reviewing existing regulations, for example, health and safety, and monitoring new laws in real time to determine whether any new laws might require you to take steps that might impact your contractual commitments. As we look beyond 2020 into 2021 and beyond, what are some of the things that you should be doing to make sure that you're best positioned for the future? Probably the key thing is the 2021 budgets. And I guess calendar year companies typically start thinking about their 2021 budget in the summer. And unless there's a lot more clarity in the very near future, it's very possible or even likely that 2021 will be the hardest year to budget for some time. A lot of companies use the prior year actuals as a base, and then they add on a desired growth parameter. But just using 2020 as a base unadjusted won't be feasible for many organizations. It's more likely that you're also going to have to look to earlier years and also form a view as to what the outlook is likely to be in your specific marketplace. We just don't know what the rebound's going to look like yet. But as leaders, you're going to have to supply some direction as to what you believe your 2021 budget should look like. And when you prepare your budget, when companies prepare their budgets, maybe 90% of the time their focus is on the P&L, and then the balance sheet is filled in right after the P&L. And then last of all, the cash flow budget's prepared. And sometimes that cash flow budget isn't pushed down to the monthly level. Well, that cash flow shouldn't be an afterthought going forward. It should be a much more integral part of the overall budgeting process. When you've developed your cash flow budget, that's an ideal time, and you'll be in a good position to evaluate whether your financing arrangements are adequate. You might want to revisit your line of credit facility. And turning again to the contracting arena, you want to evaluate what your stance is going to be in terms of potential future pandemic situation, particularly regarding contracts you haven't signed yet. Are you going to be adequately protected? Force majeure is a common clause in many contracts, and it's a clause that essentially frees both parties from liability or obligations when there's an extraordinary event or circumstance that's happening that's beyond the control of the parties, an event that prevents one or both parties from fulfilling their obligations under the contract. Now, in practice, most force majeure clauses, they don't excuse non-performance entirely. What they do is they suspend it for the duration of the force majeure event. I read that Dick's Sporting Goods has sought to invoke a force majeure clause to justify non-payment of rent while they're closed. These force majeure provisions, they do tend to vary widely state by state. In particular, I know that New York and Delaware, they tend to interpret them very narrowly. But as with anything legal, it's important to get specialized legal advice. Insurance is another area that you'll want to evaluate in light of this year's events. lots of people expected that their business insurance, business interruption cover would sort of step up and protect them during the pandemic. But in the bulk of cases, that has not proved to be the case. Insurance companies started to specifically exclude from business interruption cover communicable diseases and biological agents following the SARS epidemic back in 2003. Now, some businesses have bought specialty pandemic insurance, but they're very much the exception rather than the rule. You might have read that the Wimbledon tennis tournament, which is scheduled for June, that was canceled this year. Well, apparently over a decade ago, Wimbledon's Risk and Finance Committee insisted that they buy this specific insurance coverage. And so for them to cancel their 2020 tournament was a relatively easy decision to make. The COVID-19 experience will generate market pressure for the insurance sector to respond with coverages, but given the difficulty of pricing that risk, I think it's fair to say that we can expect pretty hefty premiums for insurance of that nature. And some legislatures are moving to mandate coverage for pandemics. Now, in the accounting area, and particularly as you start to think about your 2020 financials, which would be, for calendar year companies, would be issued in 2021, there's a few things to be aware of. And firstly, kind of setting the tone, every fall, while they plan their year-end audits, all the big accounting firms brief their teams on risk areas. So what this means is that your audit teams will be focused on these risk areas. They'll be more skeptical. They'll want more audit evidence. And they'll also want more persuasive audit evidence before they can conclude. And here are some of the most important areas to consider. Firstly, asset realizability and impairment. Inventory is an area here, the valuation of inventory, lower of cost and net realizable value. But probably the most significant area is the valuation of goodwill and intangible assets. And when I say valuation, I mean whether or not there'll be any impairment charges. Now, companies typically, they prove the recoverability of these assets by demonstrating that their fair value, which is demonstrated by the future discounted cash flows, the fair value exceeds the carrying value. However, if your 2020 actual cash flow turns out to be to less than what you predicted in the prior year, then this might call into question, at least in the auditor's eyes, it might call into question the reliability of your future cash flows prediction skills. However, hopefully you'll be able to show that 2020 was just an anomaly and that your future cash flow predictions are otherwise reliable. Now, by default, financial statements are presented on the going concern basis, and this is something that auditors have to evaluate every year. That evaluation is usually fairly perfunctory, usually pretty routine, and hopefully the remaining months of 2020 will show enough rebound that going concern won't be a widespread issue in financial statement auditing next year. Loss contingencies. Loss contingencies covers a fairly wide range of things, everything from contractual commitments and guarantees, indemnifications, self-insurance obligations, as well as legal exposures. Very much a facts and circumstances based approach for loss contingencies. And then the final specific item I wanted to touch upon is income taxes. The main thing here being the realizability of any deferred tax assets that you may have on your balance sheet. Will there be sufficient future taxable profits to recover any net operating losses being carried forward? Now, the thing is, when there have been cumulative losses over the last 3 years, and when I say cumulative losses, I mean all-in losses, which is operating losses, pension losses, investment losses, everything that runs through comprehensive income, not just your income statement. So when you have comprehensive income losses, cumulative losses over the last 3 years, there's a presumption under auditing standards that a valuation allowance will be needed. And if that's the case, the accounting firms really insist upon solid audit evidence to overcome that presumption that no valuation allowance is being recorded. So Bill, those are the specific things I wanted to speak to. I'll turn it back to you.
Thanks, Rob and Jason. Great overview for what every company should be doing now in the near future and beyond. I hope everyone out there found it as valuable as I did, and we really thank you guys for putting together a great program. And thank you to everyone who participated in the poll. Let's see what the results are now. We are going to end the polling, and we'll share the results. First question, have customers approached you regarding concessions? It looks like we kind of split there. 22% had numerous, 37% had isolated companies approached, and 43% none. So interesting, kind of a split with the group. Have you considered 2020 target implications so far? 54% yes, formally revised and changed 2020 targets. Good for you guys. Yes, but 2020 targets can't be changed, 4%, and no, we haven't formally looked at, 41% there. So interesting results, good stuff. And again, we appreciate everyone participating in the poll. I'm going to move on to the questions and answers. And we are going to start with the first question that we received. And it is, how do we deal with the unknowns in the supply chain? And Jason, I'm going to hand that over to you.
Yeah, thanks, Bill. And I think there's probably a really long answer here, but the short answer is communication. So I would say it's understanding your supply chain, both inbound and outbound, and then clear communication and forecast about what your needs are and what their capabilities are. And I'll give you a quick example. My wife is a dentist and by trade owns a dental practice, and we will not be able to get PPE in the short term. So when we are allowed to come back to work, that's a critical concern of ours. So we're starting now to talk through our supply chain folks and look for alternative sourcing, because we know it will be an existing problem for the next 3-4 months. So again, it's really communicating with your supply chain early and ongoing, making sure you're a priority for them.
Thank you. Next question, to free up cash, do you recommend reducing base salary for salespersons and increasing their commission package for possible accounts won settled over a period of time, reinstituting their base after predetermined time with end of COVID-19? Rob, do you want to take that one, or?
Sure. I think compensation arrangements, commission arrangements should absolutely be evaluated. I think that's very much a facts and circumstances based approach. I think a lot of people's compensation, companies have decided that in the near term or midterm, the compensation for many people has to kind of take a temporary hit. And I think, salespeople are not exempt from that. But the key thing is to make sure, as I mentioned earlier, that motivation is kept up. So the last thing you want to do is to sort of do something that's going to have a severe negative effect on people's motivation.
Yeah, very true. Being a sales leader myself, it's something you got to be very careful about. And if you guys have any other questions that you'd like asked, you can just push the Q&A button at the bottom, and we'll be sure to get to those. We have a few more to go through. What big changes to business do you expect after we get through this pandemic? Rob, you want to take that one as well?
So I'll speak about it from a finance perspective. I think the biggest change from a finance perspective is that finance is going to have to be much more forward-looking than they have been in the past. It's the kind of the comfort zone of finance folks to kind of default to reporting historical information. But we have to be much more forward-looking. And for people that are already in an exclusively financial planning and analysis function, FP&A, that's kind of their stock in trade. But for smaller organizations, they don't necessarily have somebody that just wears that hat. They have more finance generalists. And I think those finance generalists are going to have to recalibrate their approach to be much more forward-looking.
Good point. Next question is, will the PowerPoints be available? Yeah, we will make sure everything's available. You will get a recording of this video. And if you'd like the PowerPoint as well, we'd be happy to provide that for you. Next question, please further explain furlough versus layoff. Jason, is that something you'd like to take?
Yep. Thanks, Bill. So when you think about this, laying off is terminating an employee. So I'm laying you off. I hope to bring you back, but I am terminating you and dismissing you from the company. Furlough is reducing pay hours or stopping a person from working, but you're not physically releasing them from company. So most likely, if you pay healthcare benefits, you're continuing to pay healthcare benefits. When you bring back, it's easier to bring back someone who has not been released from your company as opposed to onboarding a new person again.
Good. Next question is impact of PPP legislation on small business and any recommendations from your perspective. I'll leave it both you guys. Not sure which one you guys would rather take that.
Maybe I can start, Bill. I think we've kind of stayed away from PPP in this presentation because it's so confusing and so different for everybody. But what I would say to everybody is be working closely with your bank, understand how you're going to use PPP, and understand the implications if you don't use it correctly. Banks are operating differently. The larger banks are a little more difficult to work through getting the funding through versus maybe a community bank. In some cases, we've seen that experience. We see banks get a fee based on percentage, so larger ones may be more enticing than smaller ones in the beginning. And the sheer volume, what I would tell you is don't, if you've applied for PPP, don't count on it until you get it. The sheer volume of people applying, I think, is 3, 4, 5 million businesses at this point, last I saw.
A follow-up to that is if we get the PPP, how do you suggest managing paying staff differentially for people who are working versus people who are not?
I think, probably the best way to answer that is that's going to be specific for everybody, but I think you're going to have to do some workflow analysis and really sit down with your payroll. The key being making sure that 75% of whatever funding you get goes towards payroll, or else you will not be forgiven for that first 2.5 times. So I think that's a hard one to answer independently, but we probably talk offline a little bit.
Next question. I wish to move towards open financials. Do you have a model that you like, an i.e. game changer? Rob, is that something you want to address?
Towards open financials, did you say?
Yes. I wish to move towards open financials. Do you have a model that you like, i.e. game changer?
I'm not quite sure what the question means in terms of open financials. Oh, you mean open as in disclosed?
Probably. I think it's referring to your open financials for the team to see everything.
Yeah. Okay. Gotcha. Yeah. In terms of transparency. Yeah.
Correct.
Yeah. I'm a big proponent of being as transparent as possible and share, letting people know the impact of their decisions upon the results of the organization, whether that's P&L and cash flow, as we spoke about. So some companies I've seen kind of spend a lot of time figuring out who can see what. My default approach is to disclose as much as you can, but you obviously you don't want a situation where people look at people are seeing transaction level stuff. You don't want the president, you wouldn't want people to be able to see, say, the president of the company's travel expenses, stuff like that. That's not relevant to them. But other than stuff like that, I would be as transparent as humanly possible.
Next question. Can you speak a little more about planning for the ramping up? Jason, you want to take that?
Sure. What we're really talking about is understanding how you're going to get back to business. So from your customer base, when you feel they're going to start engaging you again. And again, some of that's, if you're a non-essential, you're closed. We don't have a lot of control over that. but starting to put the outline down for now. Okay, when we do get customers back, how are we going to interact with them? What communications are we going to do? Do we have the right products and services to sell them at this point because of disruptions in supply chain? So it's really starting your ramp up plan. Human capital we talked about. Who's critical, who's not critical. If you had 100 employees pre-pandemic and you've been shut down for 3 months and you start up, you're not going to bring probably 100 people back on day one, right? So it's all the planning and how you ramp up, but giving yourself flexibility. Hopefully that answered that question. That's a pretty comprehensive question. It can vary depending on sector and company.
Right. And if anyone, we do answer a question or you have a question you'd like to ask offline, we'll be sharing here in a second their email, Rob's and Jason's email. You can reach out to them directly as well. Next question. Do you have any sense of when business might start up again in the region?
I think that's really hard to determine, but in the short term, what I would say is you're seeing the governors of the East Coast and the West Coast start to talk about reopening plans and coordinating. So if you look at where the peaks are in different areas, New York is past its peak, Philadelphia's peak is coming up. I think we've got another, this is just a personal opinion, good month or so of mandated closures, and coming out of May into that June timeframe, you'll start to see things be eased maybe in a rolling manner based on where the hot spots are, what is a secondary or tertiary level of essential versus non-essential, and those type of things.
Yeah, Jason, I'll weigh in on that. I think I agree with what you said. I think it's also possible that there'll be an area may open up and there may be another spike and it may kind of close back down again for a spell. We hope not, but it is a possibility.
Mm-hmm. Next question. Can you furlough a staff member while waiting for PPP approval?
So I'll take that one, Bill. And I would say, yes, you can. You have to do what's right for your business. And again, if we don't, as business owners or leaders, ensure that the business survives the pandemic, then none of this really matters on the PPP side, right? So I think you have to do what's best for your business. I would double check with your HR and your legal people to make sure you're doing it in a way that's consistent across the board. But yes, as long as you're using 75% of that fund for payroll, you can furlough people while you're waiting.
Okay. In terms of business communication, marketing, and advertising, what do you think the landscape will look like in the next 3, 6, 12 months? What are the best ways for companies to reach their audiences? Will companies invest to a greater or lesser extent? Is this a priority?
I'll take that one, Bill. And I would say it's probably one of the biggest priorities right now that you can be thinking about. Mm-hmm. Not only from you communicating back that you're still in existence, how you've been handling things, your team's safety, right? All the things that make us a good corporate citizen or a good business citizen. But keeping close ties with your specific customer segment or segments is critical now. They need to know you're still around. They need to know you're going to come back. And then how you come back and how you handle things differently. Communication is going to be of the utmost importance for the next year, in our opinion.
And I'll add on to that, as you know, I oversee the marketing and sales component of ECS. We're seeing an increase in spend both with digital reach outs and webinars. There's a lot of communication going on with our customer base across the way, and we're seeing an increase in because there's definitely a pivot going on in how customers are interacted with and the message that's being delivered. Next question. How should this event change the just-in-time liquidity philosophies B schools have been preaching for the last 30 years? Good question. Rob, you want to take that one?
Yeah, sure. I can dive into that. I think I think as we come out of this, I think people will be taking a very hard and kind of critical look at the extreme version of just-in-time, production and inventory levels and safety stock levels. I think people will definitely be building in and should be building in more of a margin of error. And particularly, you know, we see that. I mean, the food supply chain is one area that each of us has a real personal interest in, and anybody kind of going to a supermarket kind of a week after the lockdown, or trying to get an Amazon, you know, fresh delivery from Whole Foods, and you know, they've found themselves stymied, and I think companies will definitely be building in much more of a kind of a margin of error going forward.
Last question. We are able to sell our core services at this time as we have a savings model for telecom savings. What are you seeing as the best approach to re-enter the market? Meaning, are you seeing LinkedIn webinars as a nice re-entry point? I don't know if you want to add to that, Jason, or Rob?
Yeah, I would agree with that statement. And yes, it is one of the best approaches. And I think your communication plan, your outgoing mail, people are paying a lot of attention right now because it's the primary form of communication. So your campaigning, right? Your communication, your drip campaigning, and how those things go on right now via Zoom, LinkedIn, webinars, Twitter, Instagram are going to be critical in the short term.
Yep, I think those are great places to deliver your message, as Jason said, and it's a good place to start. So, well, thanks again, everyone, for joining us today. If we can be of any further assistance, please feel free to reach out to either Rob or Jason on the emails on the screen. We wish you all success and health moving forward, and we wish you good luck in the future. Thanks, guys.